Welcome back to Future Vision, where we break down the futures markets, real estate, and technology shaping our world. In 2026, the conflict between the US and Iran delivered one of the biggest shocks to energy markets in decades. CL is the futures contract for West Texas Intermediate crude oil, the key US oil benchmark traded on the NYMEX. Before the conflict escalated in March 2026, today, we're dissecting exactly how it hammered CL crude oil futures, drove oil prices sky high, and rippled through the global economy. But when US and allied strikes targeted Iran, traders immediately began pricing in severe supply risks, shocks to energy markets in decades. With the port's ventilazine prices were hovering comfortably around the $70 per barrel, futures went into overdrive with sharp volatility as the market absorbed geopolitical headlines in real time. 26, the conflict between the US and Iran delivered one of the biggest shocks to energy markets in decades. The main catalyst was Iran's response, threats and disruptions to the Strait of Hormuz. This narrow choke point carries roughly 20% of the world's daily oil and LNG supply. The conflict between the US and Iran delivered one of the biggest shocks to energy markets in decades. The effective closure, or heightened risk, created the largest energy supply shock. Strategic petroleum reserves were tapped, and US production ramped up exports. Speculators in the futures market piled into long positions, amplifying the move through positioning and risk repricing. But the fear premium dominated. Speculators in the futures market piled into long positions, amplifying the move through positioning and risk repricing. The geopolitical event rapidly translated into massive futures price action. The headline triggered a surge in volume and volatility. Prices spiked, then corrected, showing the market's swift response. The result, Brent crude, the global benchmark, surged from around $70 pre-conflict to peaks exceeding $110 per barrel during the height of tensions. Market's swift response. CL futures closely tracked this, with explosive rallies on escalation news and sharp reversals on ceasefire signals. And volatility. Prices spiked, then corrected, showing the market's swift response. The futures curve shifted into strong backwardation, signaling tight near-term physical supply. Even after a mid-June memorandum of understanding and ceasefire framework brought some relief, prices remain elevated compared to pre-war levels, with ongoing flare-ups keeping voltherks and falling flare-ups keeping volatility alive. Toward $4 per gallon, and jacked up costs for diesel, jet fuel, and shipping. Airlines, manufacturers, and consumers worldwide felt the pinch, fueling inflation and raising recession fears, particularly in oil importing economies, global supply chains, and gave a temporary boost to US domestic producers. It served as a stark reminder of how a single regional conflict can threaten economic stability through energy costs. US-Iran ceasefire framework in place, prices have pulled back toward the $75 to $85 range, but uncertainty lingered. Subscribe to Future Vision and turn on notifications so you never miss our weekly futures analysis, real estate tips, and tech insights.